This is Dr. Duru from Ahan Analytics with the market breadth. After 5 straight down weeks, the S&P 500 and the stock market in general finally had an up week. And in fact, this up week was so strong that it looks like a bottom is finally in the making. I know that seems strange because oil prices soared on Thursday. And yet, stock prices also soared. They were down 2% after a negative reaction to the president's update on the war. But then the key news that happened was that apparently Iran is working with Oman to get an agreement on opening the Strait of Hormuz. It's not really clear who will qualify for safe passage, but the market responded positively, closed high enough on the day to flatten out the earlier losses. So again, like I said, these are important movements in stock price that suggest to me that a bottom is in the making. And what's also interesting is that market breadth is finally the friend of the market. It is supporting the notion of a bottom in the making. Now, I can't declare or predict that this is the bottom, but I see all the signs of a bottom in the making. It's not yet confirmed. We still need to see closes above the key 200-day moving average trend lines. And as always, because there is a war going on, a very tragic, very destructive one going on, that alone should be a big footnote on anything and everything that we look at in the market. So as I always say, there's so much going on, so many declarations being made, so many claims being made, so many threats, so much news that I step back and I'm not trying to predict any outcomes from all this geopolitical tension. My main interest is in looking at how the market responds to the news. And what I see is the market is finally getting to that point where it will take something worse to get the market to sell off. So eventually, as I always say, that fear in the stock market just doesn't last long. It takes a lot of energy to maintain fear. And there has been a lot of fear going into last week's trading. And it looks like that fear is finally exhausting itself. Again, I can't predict it, but that's the signals I'm seeing. All right, enough talk. Let's take a look at those charts. All right, let's set the stage with oil prices. This is ticker symbol USO, the United States Oil Fund. And as you can see, it soared 11% on Thursday. And this was after the president's speech about an update, excuse me, on the war. If you had told me that USO had increased 11% to a new high, this goes back to 2015. I won't change the chart to show that, but this is a major breakout for oil. And yet the stock market was able to recover. That to me is one of the key signals that the market is now starting to absorb bad news and is actually going to take somehow even worse news to get the sellers motivated. All right, so this sets the stage. The next thing I want to show is market breadth. This is AT50. My favorite technical indicator, I call it AT50 for above the 50. This is the percentage of stocks trading above their 50-day moving averages. And while I was really hoping to get to the official oversold level, that's down here, 20%, it looks like that back on March 20th, that is indeed going to be, for this cycle anyway, close enough to oversold. Because what you can see here is that the next time it came down, it rallied, it came down, but it didn't set a new low. And instead, look at this. We are in the process now of new highs. We have a high here. Actually, let me go ahead and show you with some lines. Actually, let's do a big fat arrow. So right here, we have a high, right? After the bounce, it came down and look, it didn't punch the new low. And now we have another higher point right there. And in fact, this point is higher than the close from March 17th. All that to say is we now have higher lows and higher highs. That means market breadth has bottomed. And I should say this is a bottom again. So I think of this as in cycles. So despite, and this is the thing I really wanted to point out here. So despite oil soaring, USO soaring 11% to a new 11-year high, market breadth was able to expand by almost 3 percentage points, and AT50 closed at 35.1%. That to me says that we are not going to visit the technical oversold level for this cycle and maybe for quite some time. All right, let's also look at the percentage of stocks trading above their 200-day moving averages, which is which is AT200. It is not quite as positive. In fact, it is not doing the same confirmation that the shorter term AT50 is doing. AT200 closed the day at 47.8%. It's not, you have to strain hard to claim that there's higher lows and higher highs here. So I won't be really comfortable declaring complete confirmation for market breadth until AT200 gets to, let's just call it 49, 50%. But that's for another day to worry about. This is the longer term view. The shorter term view does suggest that we are in the process of bottoming. Now, the next thing I said, the volatility index is our partner for market breadth because of the amount of uncertainty that's in the market, particularly from the war. And look at this. The VIX is still in its uptrend. So that, again, is something for us to be cautious about. And the uptrend is this line, this purple line here. Let me go ahead and extend it out so we can compare. Yes, and you can see the VIX still has a ways to go to end this downtrend, but it's positive. I also was hoping for another blow off top like we had back here on March 20 last month. But again, I can't get overly strict and miss the breakdown. So we still need, the VIX closed at 23.9%. We still needed to get below this purple line, okay? And that would end the downtrend, again, for this cycle. So we have the makings, we have the signs of a bottom, and this means that I am much less likely to buy puts or shorts unless I am trying to specifically hedge something. All right, let's jump into the indices. So we have the S&P 500. We can see some signs here of a bottom. Now, I said there's signs of a bottom, but I need more confirmation. So we saw the VIX hasn't confirmed, AT200 hasn't confirmed, the S&P 500 has not confirmed. So you can see here that the 200-day moving average is still looming above as resistance. In fact, the S&P 500 couldn't even get above its 20-day moving average, which is this dotted line. So I want to see, first of all, is get above the S&P 500, get above the 20-day moving average, and then, of course, above its 200-day moving average to confirm that. I'm going to say if it gets above that, I'm going to say the bottom was made back here at, let's say, 63.42. But for now, it looks like a bottom. And why is that? Because we had this monster reaction, rebound that was followed up by more buying. If this were a bear market, such a large rebound, and this large rebound was 2.9%, this was on Tuesday, the bears and the sellers would have faded that right away. And that's what we had earlier along this whole downtrend. In fact, if I were to draw, let me go ahead and draw another downtrend line here. You can see very subtly how we have broken. And sorry, this is going to be very approximate. But you see how the market is essentially broken out above that downtrend line? That's another piece of the puzzle that says we are in a bottoming process finally. Okay, so that's all very encouraging. Now, as you can expect, the NASDAQ is not quite as encouraging as the S&P 500, but we'll take what we can get. After accelerating to the downside, the NASDAQ also followed along with the S&P 500. You see the big gap down on Thursday that the NASDAQ fully recovered from. In fact, it ended up 0.2%. But just like the S&P 500, the downtrending 20-day moving average is still resistance, and the 200-day moving average looms well above the NASDAQ for a breakout. And then we have IWM, the ETF of small caps. This is the most positive of the indices because it defended its 200-day moving average support. Now, yes, it broke through, but the very next day, it gapped up neatly right above that. In fact, let me just zoom in so you can see what I'm talking about. It gapped up neatly above that 200-day moving average line. You see where the circle is right there? And that was my buy signal for IWM, I mean. And I succeeded. I bought a calendar call spread. I actually wanted to go into the coming week with IWM calls, but even on Thursday, the initial price target on that calendar call spread was taken out. So I'm not going to argue with the profit. And as I always mention, I have a large core position in IWM. This latest episode made me question whether it was time to finally lock in those profits, but I did not. I'm still sitting on that core position, and now I'm still going to trade. Now, given it seems like the market is defending 200-day moving average support for IWM, I am going to continue to buy dips from here for IWM, for the IWM call trade, whether it's a calendar call spread or a call or options outright. So this is the most positive sign that I see right now amongst all the major indices that I follow, that the small caps were able to defend, sloppily of course, but we're able to defend that 200-day moving average support. All right, let us now go into, and I forgot to mention, before we continue, we did have a jobs report, huge number of jobs. I think it was like 192,000. Don't quote me on that. It was well over 100,000, and it beat expectations. So we have positive economic news coming out of the holiday weekend and starting the next day's trading. So given all these signs of a bottom, I want to start with showing some signs of strength in the stock market. Goldman Sachs, ticker symbol GS, you can see here, over the month of March, it defended 200-day moving average 3 times, right? In fact, let me just make it clear. This was a little sloppy here, but it defended here. It defended here. Maybe arrows would have been better. Defended here, and it defended here. Look at that. After that kind of defense, I think that Goldman Sachs is trying to tell us it wants to bottom. And given the importance of financials in the stock market, Goldman Sachs bottoming is, again, one of those confirming signals. It just needs to break out above the 50-day moving average, which is this red line, and that will basically confirm the bottom for the stock for this cycle. We also have Apple, ticker symbol AAPL. It defended its 200-day moving average in the sell-off in March. And as soon as it can get above its 50-day moving average, I can get back to what I call the Apple trade, the Apple trade, and I call it the ATM actually. So the Apple trade. I'm forgetting what the M stands for. But anyway, if it gets above the 50-day moving average, it will confirm a successful defense of its 200-day moving average. And of course, we know Apple is a very important stock in tech, big cap tech in particular. Coherent Corp is ticker symbol COHR. This is one of those strong stocks that is still keeping up pace. Yes, it broke down below the 50-day moving average, but it didn't spend long down there, right? Now, this is not one I want to buy. I mean, it's been up very strongly. I would have preferred for, in a big sell-off to buy around the 200-day moving average, but that doesn't seem to be in play. And plus, it looks like the stock is probably going to just trade in a range for now. Palantir is another interesting one, ticker symbol PLTR. This is one where I bought shares instead of calls because I think it's going to take some time for Palantir to work through this mess. So the reason why I'm pulling up this chart is because once again, this level here, the 141.40 level continues to be important for Palantir. And it broke down briefly to start the week and then bounced above it. And then on Thursday's gap down in the market, it traded below that and bounced right back up. And now it's working on its 50-day moving average resistance. I like this action. It looks like the stock is digesting negativity and is gaining the courage and confidence to at least challenge once again its 200-day moving average. I didn't want to do call options this time because I think it could take a while, and I have to defer to the wild card that is the ongoing war. Anything and everything can still happen to knock off even the best technical setups and narratives. All right, so let's continue with Oracle. Now I'm going to talk through some stocks that look like they are bottoming. Oracle, you can see I made the case in a separate video that this line right here which is like 136.38, is a bottom for the stock. And I showed a long-term chart suggesting that buyers are starting to move into Oracle. That was challenged in the month of March. You can see Oracle spent most of March selling off here. Let me just draw a line to make that part clear. You can see like all of this downtrend, but look at where it stopped. In fact, I need to zoom in a little bit so you can see. Look at that. I mean, this is when I love technicals. The low, intraday low on March 30th tapped that line perfectly. And then the buyers stepped in with strength the next day and on volume. So I'm liking Oracle. I bought some shares. Actually, I bought some shares earlier. I bought more shares in anticipation of this 140, sorry, this one, let's call it 136.46 level holding. All right. I forgot when I showed oil, I forgot some commodity plays. Let's take a look at BHP Billiton. Actually, let's look at it on the NYSE. So earlier I mentioned how I got out of all my commodity plays. I was anticipating a test of 200-day moving average. On Thursday, BHP confirmed a breakout of the 50-day moving average. So I went ahead and bought back in, and I bought back in with a much bigger size than I did before. That move was challenged on Thursday's gap down, and it actually didn't recover all of its losses. So I'm on the edge of my seat there to see whether this latest trade works out. Rio Tinto, similar deal. It confirmed the 50-day moving average breakout. I moved in with big size, and then Thursday's gap down challenged that, and Rio didn't quite finish filling that gap. So again, we'll see what happens. I'm perfectly willing to get out of these trades again if this turns it into a fake breakout. What's a fake breakout? Well, that would be, in this case, in this formation, if Rio gets below, let's just call it $91, which would be the intraday low of the first day of the breakout. And that's just kind of a rule I make. These kind of rules are not hard fast. And then gold, ticker symbol GLD, one of the more important ones. If you recall, I sold a April 400 put spread. That was looking pretty shaky when gold. So I sold it here when gold fell. What was this? Another 3% after having gapped down 4% the previous day. And that selling that put was looking really precarious the next day when sellers came in with a 2.3% drawdown. But I stayed the course because gold was still so overextended below its lower Bollinger Band. That's this black line, and that describes 95% of the expected trading volatility around the 20-day moving average. And that patience has been rewarded as gold, still choppy, came back and challenged this line again, but it started to move back up. I was so tempted to just go ahead and take profits and close out that put on the 20-day moving average test here, but I decided to hold. And of course, now I'm in a little bit of a shakier ground again, but I think the way that this price action is working out, it looks like this support is going to hold. And this support is 403.26, and this was the former all-time high for GLD. Again, I gotta love the technicals, but I do think the gold trade is damaged. So I'm not expecting some, imminent resumption of this very nice uptrend that's been in place for so long. Instead, I expect a lot of back and forth, which will make gold more of a swing trade opportunity as the technicals play out. And that back and forth will include struggling to get above the 50-day moving average. Again, this is just what I'm preparing for, and struggling to get above the 500 level. So I'm expecting a large trading range between 400 and 500 to develop over time. Let's get into some more tech stocks. This is AMD, ticker symbol AMD, Advanced Micro Devices. Speaking of getting into a swing trade mode, AMD has definitely been in that mode. I have been buying close to the 200-day moving average and selling close to the 50-day moving average resistance. So 200-day moving average is support, 50-day moving average is resistance. And look at this. It's making one more attempt to break out above that 50-day moving average. If it can follow through, unlike this time, you see right here, like this time, let me just show the arrows so you can see it very clearly. This was a fake breakout, right? Because yes, it got above the 50-day moving average, was well overextended above the upper Bollinger Band, and then sellers took it right back down 7.5%. That looked like the end. But when buyers stepped in here and defended the 200-day moving average yet again, that was the tell, right? And I bought when AMD opened the next day above the 200-day moving average, and I sold somewhere the very next day. I just put in a limit order at 210 because I was playing this range. But now it looks like AMD, with this nice 3.5% move and breakout above the 50-day moving average, could be ready to continue higher, right? And maybe even challenge this double top, which was the thing that's been concerning me for quite some time for AMD. So we'll see what happens. On a follow-through buying, as long as it's not too far above the upper Bollinger Band, I don't mind buying a little bit of AMD, hopefully for a longer-term position. Dell is another impressive one. And remember, these are AI-related trades. Dell just has been totally contrary to the market's weakness after this 21.9% post-earnings gain. It even soared to a new all-time high. Yep, new all-time high here. But again, notice the pattern. It went well above its upper Bollinger Band, and the sellers, given the pressure in the market, finally stepped in and took a bunch of profits. It took Dell all the way back to 20-day moving average support, and now that 20-day moving average support is confirmed. This is a buy for me. I really should have been on point to buy on that test, but I now have Dell top of my shopping list, and I'm going to look to buy and hold as long as it keeps above the 20-day moving average for a swing trade. Google, I mentioned this one last time. I thought that Google was close enough to the 200-day moving average support to start buying it. It's worked out. I'm trying to hold this as a long-term position. As a swing trader, the swing trader part of my brain was so tempted to go ahead and take profits at 20-day moving average resistance, but I'm trying to hold on because this is supposed to be a long-term position. We'll see what happens. This is ticker symbol. This is Alphabet, ticker symbol GOOG. And we all know about the software stocks struggling. They did not participate as strong as you would expect in the rebound, last week's rebound, but it was still an up week for software stocks. The downtrend is still, of course, definitely in play, but I went ahead and bought back into IGV after it dropped so far below its lower Bollinger Band. And look at this, it tested perfectly. Let me draw in that line here. It tested perfectly the previous closing low. Again, you got to love those technicals. Last time I missed that perfect spot to buy. This time I did not. I jumped right in as soon as the IGV tested. And IGV is the iShares Expanded Tech Software Sector ETF. This is going to be a long journey. I recognize now that the market's panic, what's called the SaaS apocalypse, I call it the sauce apocalypse, is all about the market expecting that the terminal value of a lot of software companies is zero. They're not going to go bankrupt next week, next year, or 2 years. But if the market has concluded that a business is going to be non-viable at some point in the near future, there's hardly any point in the long-term investors buying, right? This will be now the playground for short-term traders. But I still think there are some key software stocks that are going to survive just fine after we get through this AI panic. And I've already talked about those. I won't review those. IGV, I just consider something to trade while I wait for the recovery to happen for the individual stocks. Now, interestingly, in tech land, Tesla is one of the big laggards. So now I've finished going through the strength, and now let's look at a key laggard, which is Tesla, ticker symbol TSLA. You can see here that it did not participate in Thursday's big rally. In fact, it went the exact opposite way, big 5.4% loss. This was in the wake of the latest order data, the monthly order data that Tesla does. I won't go through all the details on that, but again, just looking at the market's reaction, the market didn't like it, took the stock well down. Now, this downtrend has been pretty persistent all year, has been very persistent all year for Tesla. It is as bearish as can be, but sellers are not going to be, the bearish momentum now needs confirmation from a new low. Given the market may be bottoming, the general market, sellers might be hard pressed to break Tesla down to a new low. So I've got this one also up on my list. I'm not quite sure how to trade it, but I'm just very interested to see what the message from the market might be from the way it treats Tesla relative to the rest of the market. Another one that I've been watching, and I did buy this earlier in the war for a bounce off the 50-day moving average resisted, and it worked. is ticker symbol EWY. This is the iShares MSCI South Korea ETF. Now, this is a very heavily concentrated ETF. It's got Samsung, and I think the memory company name is Hynix. I think that's what it is. Those two companies, South Korean companies, dominate this index. But I'm really intrigued by it because EWY has had such an amazingly strong momentum since last year, right? Particularly since the April lows. If it gets all the way down to the 200-day moving average support, I really want to load up on the assumption that eventually South Korea will turn things around. South Korea is one of those Asian countries that's heavily impacted by the crunch in oil supplies from the war and the closure of the Strait of Hormuz. And you know what's not affected by rising gas prices are the car rental companies. I did a quick video on these companies to say I wasn't buying into the narrative that looked like a good call for a very short time. I don't know what it is. Maybe there's some news that's coming. This is ticker symbol CAR, Avis Budget Group. You can see it had an amazingly strong week over the last, what is this? 1, 2, 3, 4, 5, 6 trading days. It's managed to close 4 times above its upper Bollinger Band, well above. So it's a very overextended stock. On Thursday alone, it went up 12%. That's now, what is this? This is now filling a gap from its post-earnings loss from last July. And if it gets above that, it could challenge its, I think there's an all-time high around 330, but that, of course, would take time. But I have to give the standard warning. So I know that this looks great from a momentum perspective. There's the volume here. It's very strong, but it's overextended. It's going parabolic. These moves come to an end, and when they end, the price action on the other side could be very steep and ugly. And I've shown lots of examples of this. I don't think CAR is going to be an exception to that rule. And in fact, I did a small test short on this one just to see whether I can be in position for when this thing falls off on the other side. But again, I'm amazed. And actually this episode, and I'll just spend just one more minute on it, this episode demonstrates how you could put together all of the data, come up with a great data and evidence-supported narrative, and yet and still the market disagrees with you and just continues to do its own thing. That's what happened with CAR. Hertz, also ticker symbol HTZ, same thing. Now, interestingly, the whole narrative about people rushing to rent cars because they were frustrated about TSA lines was actually centered on data that Hertz had provided. So this is Hertz Global Holdings, ticker symbol HTZ, and yet it has not benefited nearly as much as Avis has. So I don't know why there's such a huge divergence. I don't know whether Hertz is going to finally play catch up. But I'm just very interested that Hertz hasn't benefited from its own news as much as CAR has. So anyway, that's all I have. That's plenty, I'm sure. Again, as a reminder, please subscribe to the channel if you want more content like this. Put any comments or feedback down below. And share and like this content so the algorithm knows what's up. That helps out the channel. Let's just do a quick review of the S&P 500, just so I can summarize. The point that I'm trying to make is that a bottom is in place. The buyers left behind this strong selling, very strong. I pointed out how the steep downtrend is finally broken, but the S&P 500 still has to break up above its 20-day moving average resistance and its 200-day moving average resistance to confirm that this bottom is indeed in place. And then if we look at the weekly chart, let's just look really quickly. You can see the other important feature here. Let's get rid of all of these labels. You can see here on the weekly chart, it also suggests that a bottom is in place. You can see the accelerated selling and this big up week, 3.4%, right? In fact, let's just totally emphasize what's going on here. Here's the weekly downtrend. Sorry that all of these symbols have to come back in. And the S&P 500 is just barely peeking up above that downtrend, right? All right, so that's the review. War is still in play. There is no end in sight to this war yet, but the market is trying to see the end of the war, or at least the end of the negative catalyst that the market cares about. And when it comes to the trading and investing side, that's what I'm caring about, is how is the market interpreting the data and the news. On the human side, let's continue to remember this war involves real loss of life, real destruction, real tragedy and misery for a lot of people on across the region. Okay, so let's not forget that, and let's hope that this war, and in fact, whatever's on the other side of this war, does lead to outcomes that are good for the better good of not just the civilians that are caught in this thing, but just the world in general, right? Can we all just hope for a world that is just more peaceful? And I'm going to end on that really lofty, hopeful note. All right, everyone, thanks for checking this out. And I will see you the next time. Don't forget,